Partnership distributions.
Let's talk about distributions. A partnership is not a taxable entity. The income and losses flow through and are reported on the partner's individual tax returns. Partners are taxed on their distributive share of income, whether or not it is actually distributed. Let me say that again. Partners are taxed on their distributive share of income, whether or not it is actually distributed. So, for example, if you have a partnership and there's two partners, let's say it's me and my brother, and we're running a business together, and the business has $100,000 in profits. We're each going to pay tax on $50,000 of profits. That's our distributive share of partnership income. He gets 50% of the profits. I get 50% of the profits. But we're going to pay tax on that whether or not it is actually distributed, which means whether or not we take money out of the partnership bank account, whether or not we get a check, whether or not we pull money out, we're going to pay tax on the profits, just like a Schedule C taxpayer, just like a sole proprietor, right? If you have a sole proprietor, they're going to pay tax on their profits, whether or not they take a draw, right? With a sole proprietorship, it's called a draw. That's what you put into your bookkeeping software when the sole proprietor takes money out of the business for himself. That's a draw. And partners can take money out of the business too. That's a distribution. But with a sole proprietorship and a partnership, the partners in the business or the owners of the business are going to pay tax on their distributive share. They're going to pay tax on their distributive amount of the profits. And they're going to do that whether they pull money out of the business or not. Okay. So when they pull money out of the business, that's a distribution. For a sole proprietor, we call it a draw. But it doesn't affect the amount of money that they have to pay tax on. They have to pay tax on their distributive share of the profits, whether they pull money out of the business or not. Okay? Partnership distributions may include the following. Distributions of the partnership's earnings for the current or prior years. A withdrawal by a partner in anticipation of the current year's earnings. A complete or partial liquidation of a partner's interest. And a distribution to all partners in a complete liquidation of the partnership. These are all different types of partnership distributions. This is when a partner is receiving money or property from the partnership. It's getting distributed to them. All partnership distributions are either current or liquidating. A liquidating distribution terminates a partner's entire interest in the partnership. This generally happens when a partner is no longer a partner in the partnership or the partnership itself no longer continues to be in existence. A current distribution is one that does not terminate the partner's interest in a partnership. Now, I want you to understand the difference between these two because they are really different. A current distribution happens when you pull money out of the business, but the partnership continues on. You continue to be a partner. A liquidating distribution can be when the partnership is actually closing down its operations, or a liquidating distribution can happen when just one partner leaves the business, either because that partner wants to retire, or they want to get out of the business, or sometimes it'll happen when a partner dies. That particular partner is getting a liquidating distribution because they're leaving the business, they've retired, they've died, but the partnership can continue on. You can have a type of liquidating distribution where all of the partners get liquidating distributions and the partnership actually closes down, but you can also have liquidating distributions to just one partner. One partner is going to retire, or one partner died, or one partner is leaving the business, but the partnership continues on. A current distribution, though, is when that partner continues on in the business and they're just pulling money out, or it's a current distribution to all the partners in the business and the partnership is continuing. Okay? A partnership distribution is not taken into account in determining the partner's distributive share of the partnership's income or loss. You can pull money out of a partnership that doesn't have any profits for the year, just like a sole proprietor can, right? Sometimes a sole proprietor will pull money out of a business. They'll pull money out of their business bank account when the business doesn't actually have any profits or any profits yet for the year, right? So the same holds true for a partnership. You could pull money out of the partnership bank accounts when there's no profits, and you can also not pull money out of the partnership bank account when there is profits. Sometimes a partnership will just reinvest all of the profits, but you still got to pay tax on the profits, whether you get the money or not. That's the same with a sole proprietorship. Now, the most common type of distribution that you're going to have from a partnership is going to be a cash distribution. Usually, when partners take something out of the business, they take out cash. Okay, they distribute cash to themselves. All right, that's how they pay themselves. That's the same with the sole proprietorship too, right? Usually when they take something out of the business, they take a draw. They take a cash draw from the bank account, and that's how they pay themselves, right? However, that's going to be too easy. And if they're going to ask you a question about a distribution on the EA exam, they're going to always throw property into the mix. Because a cash distribution is easy to understand, right? You just pull money out of the business and that's a distribution in cash. But they want to make it complicated. So they're going to ask you about property distributions or a mix where it's cash and property at the same time. They pull out cash plus property in the same distribution. So you have to know how these are treated when a partner actually distributes property to themselves. If the amount of cash or the cash portion of mixed cash and property in a distribution exceeds a partner's basis in the partnership, then the excess of the cash distribution over the partner's basis will normally result in a capital gain to the partner. Now, I want you to understand that cash distributions in excess of basis are really unusual because usually a partnership, when you have a partnership or a business, they don't have money in the bank to distribute beyond their basis. They don't. So these are really unusual for a partner to actually recognize a capital gain because they're receiving a cash or a property distribution in excess of their basis. It doesn't usually happen because that means that the partnership actually has to have cash in the bank that exceeds the partner's basis. Now, this did actually happen when partnerships were getting PPP loan money. I'll tell you that. That's a great example because in the past I used to think, how am I going to explain this? But I did see it happen when partnerships were actually receiving PPP funds. They were getting PPP loan money and they were pulling the money out before it was forgiven. And then in that case, you have a capital gain if you receive a cash distribution in excess of your basis. It just doesn't happen very often because most of the time the partnership doesn't have the cash flows to support that sort of thing for the partner to actually be receiving cash in excess of their basis. However, if they do receive cash in excess of their basis, it normally results in a capital gain to the partner. It's just most of the time you don't see it because partnerships don't have the cash flow to do that. If a property distribution exceeds a partner's basis in the partnership, this will usually not result in a taxable gain, but the partner's basis will be transferred to the asset that's received in the distribution. And this is why partnerships are desirable for holding real estate, because most of the time when you have a property distribution, it's not a taxable event if the partner has any basis in the partnership. That's not the same treatment with a corporation, whether it's a C corporation or an S corporation. Usually when you have a property distribution, it's a taxable event. So you don't get the same tax treatment on the corporate side that you do with a partnership. A partnership does not recognize any gain or loss because of distributions that it makes to partners. A partner who receives a current non-liquidating distribution cannot recognize a loss. This is assuming that the partner is receiving a distribution, but they're continuing on in the partnership. They're not leaving the partnership. It's a current distribution. It's non-liquidating. You can't recognize a loss. But a partner that receives a liquidating distribution may recognize a loss if, number one, the amount of cash and the partnership's basis in non-cash assets distributed to the partner is less than the partner's basis in the partnership right before the distribution, and two, only cash and hot assets are distributed to the partner. Example, Henry is a 10% partner in the Brockville Realty Partnership. The basis of Henry's partnership interest is $100,000 at the beginning of the year. So this is his partnership basis. He either put this money in, this is his own money that he put in, or it's profits that he recognized already as taxable income, but he hasn't pulled the money out of the business. So this is his basis at the beginning of the year. He receives a distribution of $40,000 in cash, as well as a parcel of farmland that has an adjusted basis to the partnership of $80,000. Now, we tried to make this example easy because you don't have any depreciation when it's land, right? So the basis of the farmland is $80,000. So the partnership, let's say, paid $80,000 for this farmland. Henry's basis in the farmland is limited to $60,000 because he had $100,000 of basis and he received $40,000 in cash. So this is a mixed distribution. He's getting cash, plus he's also getting property. So he has a $100,000 basis. He received $40,000 in cash. That's the cash he received. And then the basis of the farmland is $80,000 in the hands of the partnership. But what ends up happening is his remaining basis transfers to the land. So his basis in the land is $60,000, since the total amount can't exceed his partnership interest. After the distribution, his partnership basis would be zero. Okay, his basis is zero. But he recognizes no gain on the distribution as the amount of the cash received is not in excess of his outside basis in the partnership. So this is not a taxable event. I want you to understand that. He had $100,000 in basis at the beginning of the year. He receives $40,000 in cash, and he also gets the farmland. What ends up happening is his basis is reduced by the cash first, and then any remaining basis is transferred to the farmland. So his basis in the farmland is now $60,000. And he doesn't recognize any gain or loss on this distribution, but his basis in the farmland is $60,000. If he just holds on to it, then this is not a taxable event. He will only recognize gain or loss if he later sells the farmland, when he eventually sells it or disposes of it or whatever. So this in itself is not a taxable event to Henry. Hot assets. You need to know what these are and the relationship that hot assets have to partnership taxation. These are ordinary income producing assets when held by a partnership. The main two examples are inventory and accounts receivables. A gain or loss on a sale or exchange of unrealized receivables or inventory items a partner received in a distribution is generally treated as ordinary income or loss when later sold by the partner. So for example, if I were to be a partner in a partnership and I want to leave, I want to get out of the business, and the partnership doesn't give me any cash because they don't have any money, but they give me inventory instead. Like, oh, we don't have any money to give you. You're leaving, but we will give you, X amount of inventory. And I accept it. I want out. I take the inventory. If I receive the inventory and I were to sell it later, let's say I sell it immediately, like 6 months later, I go on Craigslist and I sell it. Then I have to treat that as ordinary income. I can't treat it as a capital asset. That's the main concern that the IRS has, that a partner receives these types of receivables and then they're going to try to treat them like capital assets, but they're not. They're hot assets, and I have to recognize any gain from the sale of these hot assets. If I leave the partnership, I have to treat it as ordinary income. They receive this treatment because these are assets that would have generated ordinary income for the partnership if they were sold in the partnership's hands. If I were to receive any of these assets, then I have to recognize ordinary income if I were to later sell them or recognize income from these types of assets, even if I were to leave the partnership. Now, with regards to inventory, if I were to actually hold that inventory for 5 years, there's an example in the book like this. If I were to hold that inventory for 5 years, like if I were to get inventory from a partnership and I leave the partnership and they distribute inventory to me, if I just put it in my garage for 5 years and leave it there, then after 5 years, I can actually get capital gains treatment on the sale of that inventory. But if I were to sell it immediately after leaving the partnership, then I have to recognize ordinary income on the sale because it's considered a hot asset. And let me give you an example. This is an example of hot assets. Triple Crown Accountancy, LLP, is a partnership with 4 equal partners who are all licensed accountants. So this is an accounting firm, and there's 4 partners, okay? The partners have a major disagreement about the direction of the firm and decide to go their separate ways. Triple Crown Accountancy liquidates on December 10th. So this LLP is dissolved. The partners decide to just dissolve the business, and they're going to receive liquidating distributions, okay? The partnership does not distribute any cash to the partners, maybe because the partnership doesn't have any cash to distribute, but it does distribute $30,000 in unrealized receivables to Dylan. Unrealized receivables, especially with regards to a business like this, are open invoices that are still pending. With financial services firms like this or consulting firms, many times they will invoice their clients on a monthly basis or on a quarterly basis or after the services are provided. That happens with legal firms too. They will bill you afterwards for the services provided because they don't know exactly how many hours they're going to be billing you for. I know my intellectual property attorney actually does bill me after the fact. So many times with these kinds of services firms, financial services or professional services firms, they will have unrealized receivables or pending invoices. With regards to this sort of distribution, if the partners receive these unrealized receivables and then they get money from these clients after the fact, then they have to recognize that as ordinary income, right? So Dylan received $30,000 in unrealized receivables. That means he's going to receive the money from these clients. The business is closing, right? But these invoices are still open. The clients haven't paid. They're going to pay. And maybe these are going to be his clients that get distributed to him in the future. He gets this part of the client list. Like he's working with these people already. And so they're going to be his clients, or they have pending invoices and they've agreed that he's going to get this money. That's what an unrealized receivable is. They're like pending invoices that get distributed to him. He hasn't gotten the money yet, but he's going to. The partnership actually dissolved on December 10th. So it dissolved in the prior year. And then in the following year, in January, let's say 30 days later, because most invoices are like net 30, right? The vendor gives you 30 days to pay many times. So the partnership dissolved in December. And then Dylan, the following year in January, gets the money from these outstanding invoices, which are unrealized receivables. Dylan receives the money for the invoices, and he has to treat that income as ordinary income, just as if the income would have been received by the partnership itself. But the partnership is closed. So the partnership's not receiving that money. He is. And he has to recognize it as ordinary income. Just as though the partnership would have had to recognize it if they had received this money. That's a hot asset. And the same would hold true if he would have received $30,000 in inventory. Let's say instead of being like a financial services firm, like an accounting firm, it was like a retail business that was selling clothing or auto parts or something like that. And maybe the business didn't have cash, but they closed down for the same reason, right? There's partners in the business. They disagree. They get into a big fight. They decide to close the business, and the business closes. And maybe the business doesn't have any money, but it has inventory. And so they split up the inventory in between themselves and they go their separate ways, right? That's fine. The partnership can do that. But if he receives that inventory, then, and then like later he sells it, for example, the following year he sells it, then he has to recognize ordinary income on that inventory because he would have had to recognize ordinary income on that inventory if he had still been a partner in that partnership. That's a hot asset in a nutshell. You have to recognize it as ordinary income the same way you would have had to recognize ordinary income if you were still a partner in that partnership.
The sale or liquidation of a partnership interest.
Sale of a partnership interest. A partnership interest is a capital asset similar to corporate stock. It's treated similarly. As a result, a gain or loss on the sale or exchange of a partnership interest is normally treated as a capital gain or loss. Now, most of the time, if you have a small partnership, like a husband and wife, or maybe a brother and sister, or father and son that are running a partnership together, most of the time, the partnership interests are not going to get sold. But there are publicly traded partnerships where they're bought and sold, on the open market. That's where you're going to see it more often, where a partnership interest is going to be bought and sold when it's a publicly traded partnership. But it is a capital asset, technically. And if you do sell a partnership interest, then it's treated as a capital gain or loss if it is sold. Now, if a partnership holds certain Section 751 hot assets, then some or all of the gain or loss may be recharacterized as ordinary gain or loss rather than capital. Gain or loss is calculated as the difference between the amount realized and the adjusted basis of the partner's interest in the partnership. If the selling partner is relieved of partnership liabilities, he or she must include the liability relief as part of the amount realized for his interest. Related party transactions. Now, related party transactions apply to partnerships just like they do to corporations. A partnership cannot deduct a loss on the sale or trade of property if the transaction is directly or indirectly between related parties. Under the related party transaction rules, an individual is considered to be the owner of a partnership interest directly or indirectly owned by his or her family members. Members of a family for this purpose include siblings, half-siblings, spouses, ancestors, parents, and lineal descendants. That includes children and grandchildren. Now, remember, it's siblings and half-siblings. So that means if you share one parent, either by blood or adoption, if you're related with one parent, then that's a half-sibling. And those are considered related parties. But step-siblings are not related parties. If you're just related by marriage, then you're not considered a related party for this rule. Related parties also do not include ex-spouses, in-laws, aunts, uncles, step-siblings, cousins, or step-parents. It also would not include like nieces and nephews, right? So my brother would be a related party, but my nephew or my niece would not be for this rule. And then that also includes any businesses that these individuals might own. So for example, if I own 51% of a partnership, and my father owns 51% of a corporation or a partnership, then our businesses can't sell assets back and forth and deduct losses. More than 50% is considered ownership for the related party transaction rules in this case. Example, Mason and Addie are siblings. Addie is a 60% partner in the Crown partnership, and Mason is a 55% partner in the Belkin partnership. If one of those partnerships sells property to the other at a loss, the loss will not be allowed because the partnerships are considered related parties because the majority ownership in both partnerships is held by two closely related family members, Mason and Addie, or siblings, right? Brother and sister. Losses will instead be suspended until the property is eventually disposed of in a non-related party transaction. Liquidation of a partnership. When a partnership dissolves or stops doing business, it is called a partnership liquidation, and the partnership will normally pay off existing debts and liabilities and distribute to the partners any remaining assets. This is a dissolution or liquidation. This means that the partnership is stopping its business operations, is closing its doors. A dissolution or a liquidation marks the official ending of a partnership. A partnership may also dissolve when a partner dies or when one partner drops out of the business. Now, that doesn't always happen, but if you have a partnership where it's just two people and one of the partners dies, then you don't have a partnership anymore. You have a sole proprietorship. That's what's left. But many times another family member will step into the deceased partner's shoes and they will take over ownership of their partnership interest. So that can happen as well. But a partnership can dissolve when one partner dies. If there's only one partner left, then there's no partnership anymore. Then the partner that remains will carry on the business as a sole proprietorship if that's what they decide to do. In a partnership liquidation, the liquidating distributions are similar to regular distributions, except that the partner may recognize a loss if the total cash and the basis of certain qualifying property received is less than their basis in the partnership. And let me give you an example. Example, Limestone Realty is having serious financial difficulties and decides to liquidate. Larissa is a 10% partner. Her basis right before the liquidation is $9,000. This is her basis. She either put this money in to the business, right? She put in her own cash, or, maybe it's income that she's already recognized, from partnership operations, profits, but she didn't take that money out. She didn't get a distribution. So this is her basis. It's $9,000 right before the liquidation. Limestone Realty distributes $1,550 in cash to Larissa in complete liquidation of her interest. The partnership ran out of money, basically. That's what happened. Partnership ran out of money and didn't have any money left to pay her except for this $1,550. She's not going to get her whole basis back, which happens sometimes, right? You put money in as an investment to a business, or you buy stock in a corporation, you buy a partnership interest, you put money in, and sometimes it doesn't work out and you don't get your money out. Sometimes it's not profitable. In this case, the business started having financial difficulties. Her basis was $9,000, but she didn't get that back. She only got $1,550. Okay, that's a complete liquidation of her interest. There's no other assets to distribute, and the partnership formally dissolves a week later. Larissa can recognize a $7,450 capital loss on the liquidating distribution. This was her basis minus the cash she actually received. So she can get all her money back. And then she can claim a capital loss, but only when it's a liquidating distribution like this, or after the partnership dissolves. That's when they can claim a loss, when they don't actually recover their basis. That's a capital loss, and you report it on Schedule D, just like you would a capital loss from the sale of stock.
Deceased or retiring partners.
Deceased or retiring partners. Now, sometimes you will have a situation where the partnership continues on, but one partner will drop out. Either they will retire or they'll leave the business, or sometimes they will die, and then they'll get a liquidating distribution. Payments made by a partnership to a retiring or a deceased partner's estate are considered a distribution, not a distributive share or a guaranteed payment. A retiring or deceased partner is treated as a partner until his or her interest in the partnership has completely liquidated. The death of a partner will close the partnership's tax year for that partner. If you have 10 partners in a business or 100 partners in a business, if one partner dies or drops out, it's not going to stop the business. The business is going to continue on. So the death of a partner will close the partnership's tax year for that particular partner, but it generally does not close the partnership's tax year for the remaining partners. They're going to continue onward most of the time. The only time you have a situation where the partnership has to dissolve is where it's just two partners. And that's because a partnership has to have at least two partners. If there's only two partners and one of them drops out or dies, then you have a sole proprietorship. But if you have a larger partnership, 4 partners, 10 partners, 100 partners, the partnership is going to continue, even if one partner dies or drops out. A final Schedule K-1 will generally be issued to the deceased partner. Example, deceased partner. And I'm going to give you more than one example because when a partner passes away, when a partner dies, more than one thing can happen depending on what the partnership agreement says. But I'm going to give you more than one scenario so you kind of understand what happens after a partner dies. Example, John was a 5% partner in Greenway Consulting LLP, a cash basis calendar year partnership, but he's only a minority partner, so there's more than one partner in the mix. John died on August 1st. The distributive share of ordinary partnership income allocatable to John through the date of his death was $40,000. For the entire year, 5% of the partnership's income was $55,000. This is what he would have gotten if he had lived the entire year, but he didn't. He died on August 1st. So the income that was allocatable to him until his death was $40,000. John's daughter, Amy, inherits her late father's partnership interest and takes over his role in the business effective on August 1st. So sometimes this will happen where an heir or a beneficiary will step into the deceased partner's shoes. That's not always what happens, but sometimes that's what happens. And then this is what you do, okay? She takes over his role in the business on August 1st. And he was working in the business until August 1st when he died. $40,000 of ordinary partnership income would be reported on John's final income tax return. So he still has to file a final income tax return. Well, I mean, he doesn't because he's dead. But his executor, whoever's managing his estate, has to file that final tax return for him and sign it. he has to still file his final tax return in the year of death. So he's going to get that amount of income, that $40,000 allocated to him, and that's going to be reported on his final Form 1040. It's going to show up on his final Schedule K1 issued to him by the partnership. And then the remaining $15,000 of the partnership income that would have been allocated to him if he hadn't died in the middle of the year is going to be allocated to Amy on her Schedule K1 from the partnership, because she stepped into her father's shoes and started working in the business after his death. If he had lived, then the amount of partnership income that would have been allocated to him would be $55,000. But he died. So he has an allocated sum, that $40,000, on the Schedule K1 up until the date of his death. And then for the rest of the year, Amy steps in and takes over for him in the business. So $15,000 is going to be allocated to her on her Schedule K1. He was a 5% partner up until his death, and then he's not a partner anymore, right? His daughter Amy takes over his 5% partnership, and then she has $15,000 reported to her on her Schedule K1. So this is this type of example where you have like a beneficiary or a child or someone else take over in the business. This can happen sometimes where a spouse will take over. Like if John had been married and then his spouse or his wife took over for him, sometimes that'll happen too. And then in that case, the wife would have gotten a Schedule K1 with $15,000 on it. Got it? Okay. This is one scenario. This is not always what happens, but this is one scenario that can occur. Now, here's another scenario where you have a deceased partner. If a partnership has a buy-sell agreement, a buy-sell agreement is a type of legal contract that binds the partnership to buy out the interest of a deceased partner. This type of agreement helps to ensure that the business will continue uninterrupted. And many times, partnerships and small corporations like S corporations will have this type of agreement because they don't want whoever inherits the partnership interest or the share, in the case of a corporation, the shareholders' ownership stake, they don't want the heir to basically sell it to someone that they don't want to be part of the business. A buy-sell agreement will prevent that. And many times the partners in a partnership or the shareholders in an S corporation will agree to this because they don't want someone else making decisions outside of the original owners or the original founders of that company. They don't want like some hot-headed kid to come in and say, oh, my dad's dead and I'm taking over or something like that. So they will have a buy-sell agreement. It's a legal contract where basically the partnership, or in the case of an S corporation or a C corporation, they will buy out the deceased partner's ownership interest and pay the estate or pay the heirs in order to get rid of them, to prevent them from selling that partnership interest or that ownership stake to someone else outside of the company. Example, Global Attorneys LLP is a calendar year cash basis partnership law firm. So this is a law firm, so of course they're going to have everything in writing, right? When the partnership was initially formed, each partner signed a buy-sell agreement that stated that in the event of one partner's death, the deceased partner's estate would receive $400,000 in full payment for the partnership interest based on the deceased partner's share of the partnership's property. During the year, William, who is a 20% partner, dies. William's estate was paid $400,000 by Global Attorneys LLP in accordance with their buyout agreement. The entire $400,000 will be treated as a distribution. With that 20% partnership interest now no longer in existence, William has passed away, and because of this buy-sell agreement, his partnership interest no longer exists. Let's say it was 5 partners, right? William was a 20% partner, and there was 5 partners in the business. What ends up happening is now there's only 4 partners in the business, and their partnership share or their partnership interest increases as a result of his death. They have a buyout agreement, a buy-sell agreement. They pay his estate the $400,000, so no one else comes into the business that they don't know or that they don't like. And then the remaining partners, their interests will increase as a result, based on whatever's in the partnership agreement. But he was a 20% partner, and let's say it was 5 partners, then the 4 partners that are left, they would each have 25% share, if that was the case, if it was 5 partners. But I want you to understand how this works. If there's a buy-sell agreement, then the partnership basically pays the estate, and the remaining partners, their interests will increase proportionately as a result. Got it? Due dates after termination. After a partnership terminates, when its operations are discontinued and there's no business anymore, the partnership tax year ends when it's a dissolution or a termination. I think you need to know what the due date is for a partnership that terminates. Sometimes they will ask you a question like this. If you have a partnership that terminates before the end of its regular tax year, let's say it's a calendar year partnership, and normally it reports its income and loss just like an individual, January 1st to December 31st. That's a calendar year partnership. If it terminates before the end of the year, a Form 1065 has to be filed for the short tax year from the beginning of that tax year through the date of termination. The return is due on the 15th day of the third month following the date of termination. I think you need to know this. Normally, a partnership has to file its tax return on what? March 15th, right? That's the normal due date. They can request an extension, and then that pushes the due date to September 15th, most of the time, if it's a calendar year partnership. But if the partnership terminates, then that's a short tax year, and a partnership tax return has to be filed for that final year. And there's a box right on the partnership tax return on page 1 where you mark it, final year, right? And when it's a short tax year, there's a place for you to put it at the top. You put the beginning of their tax year, which is usually January 1st, and you put the end of their tax year, which is the date that the partnership actually dissolved. That's what you put. And then you mark it as the final tax return in that case. Okay? If an existing general partnership is later converted to an MMLLC, MMLLC means multi-member LLC. So if it's a general partnership and then the owners of the business decide to form an LLC, then that's not considered a termination of the old partnership. There's no sale, no exchange. The IRS doesn't treat it as if anything happened. An LLC is just a legal entity. It doesn't terminate the old partnership. A new partnership doesn't form, nothing like that. The partnership's tax year does not close, and the MMLLC can continue to use the partnership's existing employer identification number. You don't have to change the EIN or anything. If you form an LLC in the middle of the year, and you have an existing partnership already, then it's as if nothing happened, at least to the IRS. I mean, for legal purposes, an LLC is a legal entity, right? But for tax purposes, it's not as if the old partnership dissolved or closed or anything like that. You just continue to use the same EIN.
And let me give you an example of this. Example, Urban Engineering LLP is a calendar year partnership. The partnership is having financial difficulties, and the owners decide to dissolve the business. Urban Engineering terminates and stops doing business on May 3rd. So in this case, this is an LLP, so the owners of the business would have to legally dissolve this business at the state level. They'd have to dissolve the LLP. And then you'll get paperwork back from the Secretary of State that will have the date of dissolution on the paperwork. And in this case, it was May 3rd. Its final Form 1065 for the short tax year period of January 1st through May 3rd is due on August 15th. This is the 15th day of the third month following the end of the month of termination. So they terminated in May, and then it's May, June, July, August, and it is the 15th day of the third month after the termination. And this is actually a hassle. It's a hassle to do this type of a termination because they terminated mid-year. You would have to file this tax return on the prior year software because the software for the following year wouldn't be ready yet. They're dissolving in the middle of the year, and the tax return is due, 3 months later. The best solution, in my opinion, when you have a situation like this, is for the partnership to file an extension for this short tax year. Generally, you have to mail it in. You have to mail in the extension. But there's a place on the extension in order to indicate that it's a short tax year and you're requesting an extension for that. Then you just mail in the extension, the Form 7004, and then you wait. You wait until the new software is ready. And if you filed an extension, then the partnership tax return won't be late, and you'll actually be filing on the correct software for the tax year that is. But if you do file a short tax year like this, and you decide to file it in the middle of the year, then you'll have to use the prior year software in order to do that. and then you indicate that it's a short tax year or that it's a fiscal year end, and it's a final return at the top of page 1 of the Form 1065. That's how you would do it. But in general, what I do when I have a situation like this is I just extend. I extend the partnership, or if it's a corporation, I would do it too. I would extend either the partnership or the corporation and then file on the correct year's software when it becomes available.
Payment of another partner's debt.
Payment of another partner's debt. If a partnership terminates and one of the former partners is insolvent and cannot pay their share of the partnership's debts, the other partners may be forced to pay more than their share of the liabilities. If another partner pays any part of an insolvent partner's share of the debts, the partner that actually pays the debt can take a bad debt deduction on their individual tax return. And I want you to understand how unusual this is. Usually, you can't take a bad debt deduction for a debt that isn't yours. In order to take a bad debt deduction, you have to be liable for the debt. But in this case, when you have a partnership, sometimes one of the partners will leave the partnership, or they will, die or whatever, or become insolvent, fall for bankruptcy, and they won't pay their share of the debt. If that happens and the other partners have to pay that partner's debt, then the individual partners are allowed to take a bad debt deduction on their individual tax returns. That's how it's reported. And let me give you an example. Chester and Dana are 50-50 partners in Diamond Tutoring LLC, a company that provides online tutoring services. The company is struggling, and Chester and Dana decide to discontinue the business. The partnership is terminated, and it has $50,000 of liabilities to creditors after liquidating all of its assets. So it has this big outstanding loan, or this big debt out there, $50,000 debt, and it has no assets to pay anything. However, Chester has filed for personal bankruptcy, and the court has declared him insolvent. So Chester's not going to pay any of this debt because he's already filed for bankruptcy. Even though Dana is a 50% partner, she assumes responsibility for the entire $50,000 of partnership debt, which she pays herself out of her own personal savings. So she dug into her personal savings to pay this debt. She can claim a bad debt deduction on her Form 1040 in the amount of $25,000, equal to Chester's share of the debt that she personally assumed. Dana technically was only responsible for $25,000 of this debt. They were 50-50 partners, and $50,000 was the outstanding liability when the business closed. And assuming they were both liable for this loan, then they both had a liability of $25,000. But Chester has filed for bankruptcy. They're not going to get any money out of him. And assuming that the lender can go after both of them, then they can make Dana responsible for the whole thing. She paid his half of the debt, so she can take a bad debt deduction for his half that she actually paid on her Form 1040. So that's how it would be reported on her side. That's it. That's the end. Next unit is going to be Unit 12, C Corporations in General.